We had a shortened trading week last week, but a big move in sentiment on duration. Let's look at our capital market curve. Almost a nice parallel move downward by 25 basis points across the curve. And this was due to the market's more than happy acceptance of the announcement of the new Treasury Secretary, Besant. Particularly is his past discussions about limiting the amount of deficit to 3% of GDP. Prior to this, the conversation in the capital market was the unsustainability of the path that deficits were on. So this is a move in the right direction that the market seems to be very happy about. I had felt that the sell-off in TLT from 100 to 101 in that range, which I thought was too high, down to at some points we saw 89, even an 88 in there. I thought that was overdone. I really thought that we should be in a range, a tight range, 96 to 97, a wider range, maybe 95 to 98, but within that range. So I do think that this return and this shift, I should say, in the narrative and this return to a more reasonable level for TLT, I think it can find its way inside this range. So sitting at 94 right now, I think we have ways to go. So for duration, very happy about that. Let's look at slope, capital market slope, pretty much unchanged, 1 basis point, but the money market to capital market slope flattening out 18 basis points, inverted by 4,762 days. We got 26 days to beat that record, but 17 days we do have a Fed meeting, and I expect that the 3-month will drop on that. The probabilities here at 25 basis points up to 66 now from 52.7, so I will agree that's a move in the right direction. So I'm kind of agreeing on things here. Duration, yes. The probabilities, yes. Only 34% on zero. Let's go to the very short end of the curve and look at what's built into the federal funds futures. The effective federal funds rate is 4.58 right now. For the end of the year, if we look at the January contract, this will signal where the effective federal funds rate is at December 31st, because there is no Fed meeting in January, so there should be no change throughout January once we have the December results. 16.5 basis points. Q1 has 20 basis points of cuts anticipated, Q2 19.5, Q3 14. So over the next year, 70 basis points of cuts. I think December 1st you're going to get one. So the market is saying in 2025 there'll be 2 out of 7. Out of the 7 meetings, only 2 of them will result in cuts. I do believe that is wrong. We have 96.12. Implying a federal funds rate of 3.88% by the end of October, after the first 7 meetings of the year. I think that's wrong by at least 1 meeting, if not 2. If we're thinking 4 out of 7 next year, I think that is the better place to go. So this should be somewhere around 96.62, and I would say that seems about right. So I think there's an opportunity here for a long position. What do we have next week in terms of risk for duration? Jobs next week, jolts in 2 days. I don't know how important those are. They've become less and less important since they've come off their very high levels. The always wrong but always market moving ADP. I don't know why the market reacts to it. It's always wrong, but there it is. Just be aware that the market will react to whatever wrong number ADP throws out. And then you have the jobs report in 5 days on both sides of the border, in Canada and the U.S. FOMC is in 17 days. Bank of Canada is in 10 days. The expectation there is growing greater than 50% now on another 50 basis point rate cut. The third quarter GDP on an annualized basis, if you remove government spending, not good at all. And another quarter of GDP per capita dropping. So per person, Canada has for some time now becoming a poorer and poorer country. Also on the risk docket this week, Powell, 2:45 p.m. on Wednesday. I saw it on the economic calendar. I didn't dig into it to see, well, what's he talking about this time? But usually it has his opening of wherever he happens to be has something to do with the outlook for monetary policy, so I would be aware of that. Okay, that takes care of both ends of the curve and the slope of the curve. Let's look at the balance sheet. Reverse repo is 197 billion. The lowest was 144, but it's the end of the month. The reverse repo always builds into the end of the month and then drops after that. Reserves at 3.2 trillion. So take out 2.5 trillion off the sum of that, 931 billion at 40 billion a month. 24 months of runoff, but the discussion seems to be about mid 2025 is when balance sheet runoff will be considered in terms of stopping the runoff to approach the level of reserves that are ample a bit more cautiously. If they do that, I believe they will stop treasuries, but they probably won't stop the mortgage-backed securities. And if they take runoff to zero, out of this you've got 15 billion that are treasuries, and you got 25 billion that are MBS. So you will have incremental buying of another 15 billion a month in treasuries because these won't be run off, they'll be rolled over. Not only that, this 25 billion over here in MBS will continue, if not increase over time. And to keep the balance sheet flat, if they're allowing 25 billion of MBS to run off, they will buy 25 billion of US Treasuries. So you could get, if they take balance sheet runoff out of the picture and bring it to zero, you could get incremental purchases of $40 billion in treasuries a month because they would let the MBS continue to run off and just replace them with treasuries. That would be supportive of the longer end of the curve here. Week over week, both big markets, both duration and beta, had good weeks. TLT up 4%. Thank you very much. S&P only up 1%. Okay, let's move on to beta now. All-time high on SPY, November 29th. I think it hit all-time high a couple times last week. 602.55. Forward four-quarter operating earnings sitting at 263.58. Here's the last 5 weeks. 5 weeks ago it was 265. We're down to 263. Market is up to 603.228. So forward multiple 22.89. Pushing up against 23. Only 2 times in history has the forward multiple been this high. 1999, and that did not end well, and 2021. Last week was 22.66. Sort of in defense of this, the surprise factor from last quarter was 7.6%. That means based on the expectation, because this is an expectation here, the actual operating earnings came in 7.6% higher. So if we say, well, let's assume that we have a surprise factor, positive surprise factor for the next 4 quarters. Let's put 7.6% onto here. We get the multiple down to 21.27. Still nosebleed territory. Still need binoculars to see the stage from those seats. Implied volatility. Nothing to see here. Look at this, 0%. Last 13-week percentile, 0. Implied volatility last ended at 10%. Compare that to TLT at 12.7%. In other words, large cap equities, an index of large cap equities, has less implied volatility in it than a portfolio of US Treasuries. Just let that sit in for a minute. So implied volatility sort of disappearing. Let's just spend a moment on the put-call ratios here. This is the open interest put-call ratio for SPY, 210 versus 0.67 for TLT. This is saying for every 100 calls, you have 67 puts. And here, for every 100 calls, you have 210 puts, which is a high enough number. But we are at all-time highs. We are at nosebleed valuation levels. We are at no implied volatility. I shouldn't say no implied volatility, but the lowest percentile, 0%. You're in the 0 percentile. All the observations have been above this. Insurance is cheap. Why wouldn't you buy it? Right? So it just could be a matter of, look, considering where we are, insurance is cheap. Why don't we buy it? But it is being bought. that's the other side of the statement is, why not buy it? Well, it is being bought. So that is, I find that interesting on the put call ratio. Small caps, IWM 241, all-time high was 242.56, just a little bit below. And IJR 126.53, all-time high last week, November 26, 126.73. 600 stocks here, 2,000 stocks here. This is the S&P 600. This is the Russell 2000. This has a profit. This group has a profit requirement. So these are profitable small caps. This does not have a profit requirement. And as of now, it has the highest percentage of unprofitable companies within the index. With the strong GDP we've had over the last couple of quarters, last couple of years, the small caps within the IWM have had ample opportunity to prove themselves and haven't. I don't know what lower rates are going to do in terms of raising their revenues, because that's really what needs to be done. If you can't get it done in 3% real GDP growth, where are you going to get it done? So I don't see that IWM is going to perform as well as IJR going forward, or as well as SPY going forward. Going into the end of the year, we only have December ahead of us. Equity markets tend to drift into the end of the year. They tend to drift upwards into the end of the year, hence the term Santa Claus rally. The big risk events we have in front of us are the jobs report. We have CPI the week after, along with the Fed, and that gets us to the 18th, and then it's really into the end of the year. I think jobs, CPI, and the Fed, these are risk events more for duration than for beta. I think beta will continue to do what it has done, cover its eyes, cover its ears. I see nothing, I hear nothing, and just continue its march up. The bad news, and there's always bad news, you have tariffs coming up. There are always fallouts from tariffs. There's retaliation from tariffs. But the bad news doesn't belong to this equity market. All the bad news previously belonged to the bond market, but it's going to be hard to pin bad news on the bond market. So if the bad news doesn't belong to the equity market or the bond market, you're going to have to pin it on some other market. You're going to have to say, well, and we know it doesn't belong to the speculative assets, the crypto market, because that just keeps performing as well. So we're going to have to pin all the bad news on other markets, which is, blame it, pin it on Europe. America's bad news is bad news for Europe, is bad news for China, but it's certainly not bad news for U.S. equities. It has received no punishment for any of the potential negative fallouts. Over the weekend, Trump issued a directive to the BRICS nations about the US dollar through Truth Social. Of course, the normal platform for diplomacy, saying, if you attempt to move away from the US dollar in any way, I will hit you all with 100% tariffs. You can't keep walking around the room with your baseball bat threatening people with it. You can't just continually be a bully. It's not going to work out the way you think, right? But that's what he put out there. If you do get a strong U.S. dollar, I don't know that is positive for the S&P 500, considering a significant amount, some 45% now, of the revenues derived from the S&P 500 are global, are not domestic, but are global. So you do have translation and transaction adjustments where you have to translate foreign currencies, assets and revenues outside of the country in foreign currencies. You have to translate them into US dollars, and all of your transactions back into US dollars. That'll take a hit. So a very strong US dollar keeps exports down. It pushes down exports because other currencies, the price in other currencies have increased dramatically, and your translation adjustments. So that doesn't seem to be a factor at all, a strong US dollar. The potential retaliation on tariffs doesn't seem to be factored in at all. Just no, that's not going to happen. Everything's going to be perfect under dear leader. I don't know. But the dollar alone, I think, for the S&P should cause some grief. For the small caps, not so much. Small caps tend to be far more domestic than they are international. But I would be cautious about companies that derive a large part of their revenues outside of the country if you are going to continue to have a very strong U.S. dollar. For earnings this week, not much. We're at the tail end of earnings here. For the S&P 500, Tuesday, Salesforce.com, Wednesday, Dollar Tree, and you have Hormel and Campbell's in the consumer staples category. Thursday, we have Kroger, Dollar General, Lululemon, and Hewlett-Packard Enterprises. As far as direction for beta, if we rely on history, and with very few equity risk events ahead of us, and with the market almost unwilling to accept any bad news or any risk, I think that we probably drift up into the end of the year. Where we go after that, I don't know. But I don't see why this would reverse. Now that is assuming that no exogenous event occurs, that no catalyst occurs. You know, these unpredictable things that you can't anticipate. But if it's just business as usual, I think we drift higher into the end of the year. I'm gonna stick with Microstrategy for just a little bit longer. I do find it a fascinating case study here in the building of a cult. And I can explain that later in the week. I'm going to have another video out later in the week pointing out that we have seen all of this in U.S. history before. The whole crypto space, we've seen it before. So we can look at history and we can say, does this look familiar? And where did that go? And I think we know where this is going to go. As far as Microstrategy, this is a bomb. A pretty deadly bomb that is growing within the crypto space. The bigger it gets, the more potential it has to wipe out the whole crypto space. I will explain that in another video this week as well. My goal here is to demonstrate that the information coming out of Microstrategy is misinformation, and misinformation on purpose. I think it's intentional. When you misinform an audience, you can do it intentionally or unintentionally. Unintentionally means that you believe what you're saying, it's just wrong. Intentionally means you don't believe what you're saying, but you're saying it anyways because you think the audience is not going to know the difference and you want the audience to behave or act in a certain way that benefits you. Well, I think that's the Microstrategy strategy. This is a presentation that they had done just a few weeks ago, November 13th and 14th, 2024, the Cantor Crypto Digital Assets and AI Infrastructure Conference. And I could go through the whole thing, kind of like a reaction video, but it would just take too long. Here's the first 3 slides, and I'm going to make easy work of this. But first, before I begin, I have become fascinated with cults over the last little while, not because I want to be a cult leader, but I want to understand why are people drawn to something that is so clearly either a scam, a fraud, or just full of misinformation. Why are they drawn to these things? And I find that there are a number of common characteristics. One of the characteristics is a charismatic but sociopathic leader. And you have to be sociopathic because you cannot care whether the people who are following you lose money or not. If they lose their life savings, you don't care. You feel nothing. That's a sociopath, is that they lack empathy for any other person. How do I know that this person is a sociopath? I don't. I'm just doing it by a transitive property, which is as follows. If you had to make a list of the 20 greatest investors of all time, would Warren Buffett and Charlie Munger be on that list? I think you'd be hard pressed to argue that they should not be on that list. I think you'd be hard pressed. I think you'd say, well, yeah, they'd be on that list. they don't like crypto. They think it's just nonsense and a playground for criminals, which I believe that too. I think if you want to find the highest concentration of criminals, fraudsters, and grifters, it's in the crypto space. Now you find criminals everywhere, but the highest concentration, I think, is in the crypto space. They wouldn't touch this thing. But Michael Saylor is the Bitcoin evangelist, a two-time fraudster, versus Warren Buffett and Charlie Munger, the greatest investors of all time, won't touch this, but a two-time fraudster is promoting it, and promoting it with a heavy dose of information. If you Google his educational background, you have to ask, is it plausible that this guy is so misinformed that he believes what he's saying and he's just repeating what he truly believes? Or is he informed enough to recognize that this is misinformation, but understands that his audience won't recognize it as misinformation? Let's make easy work of these first three slides. First one, if a company can't grow organically 15% a year, institutional investors lose interest and liquidity in the firm's equity and options dissipates. That is a false statement. One company, Costco, does not grow organically at 15% a year. Look at its stock chart. It's on fire, pushing up to $1,000 a share. It has institutional support. It has no lack of liquidity. Blindfold yourself and reach into the S&P 500 at random and grab any company. More than likely, they're not growing organically at 15% a year, but they have liquidity. This is a demonstrably false statement. But nobody's going to fact check them on that, not in that audience. And it's just saying if a company can't grow. Now, if it said if a small cap growth company can't grow at 15%, it will lose support. Yes, from the growth investor institutional base, but maybe the value investor institutional base will come along. But it didn't have any qualifications to it. It just says if a company can't grow organically at 15%. The S&P 500 is just an easy demonstration of how obviously false that statement is. Let's go on to the next one. Treasury strategies based on holding sovereign debt. When he's saying treasury strategies, this is for companies. Companies have cash that build up and they make decisions about, well, what are we going to do with this cash? That is what's called your treasury strategy. What are you going to do with the money that you have? And he's saying treasury strategies based on holding sovereign debt, which is government debt, underperform. Doesn't say possibly or maybe, but underperform the cost of capital. Should say underperform their cost of capital for the company that has it, but underperform the cost of capital. Every company has a cost of capital. There isn't just one cost of capital. So messy and sloppy language aside, by up to 10% per year, destroying shareholder value. That is demonstrably false again. Any second year, third year undergrad with a finance and a corporate finance course behind them would recognize that that's a false statement. So in a very simplified way, let's say you're holding T-bills. Let's say you have $1 billion and you're holding T-bills. And let's say you're back in the era where T-bills were as low as 1% and your cost of capital is 11%, which is not unrealistic. Utilities have costs of capital around 10.5 to 11%. You would say, aha, see, there, you're underperforming by 10%. But that is not the purpose of the cash. Now, you could put the cash, you could say, well, okay, we won't hold any cash. We'll put them all in risky assets so that you have no cash on your balance sheet and they're all in risky assets. You are operating at the edge of your liquidity all the time. Your liquidity metrics will be horrible, which means your cost of debt will be significantly higher. The existence of the cash lowers your cost of capital. Capital can be debt or it can be equity. If we're saying the cost of capital, we're assuming, well, then you mean both, right? Because you're not being specific. It didn't say the cost of equity. It said the cost of capital. Debt is capital. Equity is capital. Since MicroStrategy has a a significant amount of debt in its capital structure. We'll just assume that it was meant to include both forms of capital. If you have cash on your balance sheet that is in a low volatility asset, it does lower your cost of debt. So you're going to get a lower interest expense when you float a debt issue. You can float it at a lower expense than someone else can, so that's less cash flowing out of the business. If you can float it at a lower cost, and if you say, well, there is a constant delta between the cost of debt and the cost of equity, if you lower the cost of debt, you lower the cost of equity, just keeping this constant, which means your weighted average cost of capital is lower. Now take your free cash flow to the firm. And what do you discount that at? You discount it at 1 plus the weighted average cost of capital per period. What's going to happen to the present value of all the future cash flow to the firm with a lower weighted average cost of capital? It is going to increase, which means firm value increases. So the return on cash is not the stated interest rate. It is the stated interest rate plus the lower cash expense for interest, plus the increase in the present value of all those future cash flows, which actually increases shareholder value. It does not destroy shareholder value. Now take that same company and say, okay, well, instead of having cash on the balance sheet, it's going to have no cash, and it's going to invest all that cash in a very volatile, risky asset. Would you then say, oh, well, then let me lower the cost of your debt even more? You would say, well, no, you're playing right at the edge of your liquidity. Your interest, the cash you have available just to cover interest doesn't exist. You have a risky asset that may or may not be worth what it needs to be worth. If you happen to need to sell assets, you're a much riskier balance sheet. You're a much riskier company. The cost of your debt is going to be higher. If the cost of your debt is higher, your weighted average cost of capital is higher. That lowers the valuation of the firm. That destroys firm value. So it's quite the opposite. So this is, and I think any corporate finance student can see this, is a demonstrably false statement. False. It is misinformation. Let's look at the worst of it. By the time you got to the third one, it was, objection, Your Honor. I was screaming out. This is, look at the big title. What are your eyes drawn to? Bitcoin exceeds monetary inflation and cost of capital. And here in a different color is Bitcoin. And in all the other colors, well, the lack of color, the gray color, the dull color, is everything else that you can see under here. NASDAQ, U.S. growth stocks, large cap, mid cap, value, everything over here. And this first line is monetary inflation. The bottom line is consumer inflation. And look at Bitcoin. Look at the point that it's making, right? Read the small print. 14-year annualized return on all of this versus only a 4-year return on this. Can't do that. You can't mix all of that stuff together. If you're going to compare the performance of assets, it must be over the same period of time. You can't just cherry pick and say, here's where Bitcoin did the best, here's where everything else did the worst. There we go, let's put that in to make my point. Anybody who works in data would look at this and scream, how many violations? Objection, Your Honor. Objection. Across the board. You have to compare this over the same period of time. Now, if you're trying to suggest that there is some kind of inflation component to this, let's look at the period over which we had inflation. I'm taking September of 2024, the first 3 quarters of 2024, the end of the third quarter, as the end point of the period I'm going to look at. And if you're going to be honest with the data, what you do is you choose your time period based on some theory, and then you look at your prices over that time period, as opposed to cherry picking just the right periods where the point you want to make shines through. Why am I picking September? Because that is where we had our first rate cut, 50 basis points. So we're going to say that is the end of the inflationary era when you have the first rate cut. And I went back 3 years. I was going to go back to the beginning of 2022 saying, well, we got the first rate hike at the beginning of 2022, but that was 2.75 years. It just made the math complicated. We did start to see inflation showing up in the fourth quarter, and the idea behind a hedge against inflation is it goes up in anticipation of inflation going up. Let's go back to the end of the third quarter of 2021. Let's use a 3-year period. There. Now let's look at prices. On an annualized basis, Bitcoin was up 3.68% per year on an annualized basis, but SPY 9.72, QQQ 9.59, gold 14.18%, Nvidia 182%. GPUs as a hedge against inflation, who would have thought that, right? But gold still being the king as a hedge against inflation when inflation did in fact show up, which is during this 3-year period. In fact, if you had stayed in a 3-month T-bill, you would have done better than Bitcoin. So what did Bitcoin do when inflation showed up? Let's just say it like it is. It tucked its tail between its legs and went whimpering away like a little bitch. So this is misleading, massively misleading, and because of the cherry picking, I would say I cannot see that that's unintentional, that you could unintentionally put that together. That is massively misleading as to be on the edge of manipulation, and this is the basis of the MicroStrategy story for Bitcoin is a heavy dose of misinformation. I don't believe that Michael Saylor believes this. I have a hard time, given his educational background, I have a hard time believing that he believes this. One video I did see of him way back when the iPhone first came out, he was talking about the iPhone. He was spot on that iPhone, spot on that one. So I have a hard time believing that he is this misinformed. However, I think he's smart enough to recognize that his audience is misinformed, is either willingly misinformed or has the inability to perform themselves. Either way, he recognizes that you got to keep these guys in the game to get this thing to go up. I think he sees the play here is very simple. It's these people. We can take money from these people. Let's keep them in the dark. Let's keep them misinformed. And let's buy the thing that they're going to buy before they buy it. And let's buy a lot of it, and let's continue to feed them a steady stream of misinformation. You're being misinformed. If you're thinking that you've put in the work, that you've done the work by listening to this guy, sitting in an echo chamber being misinformed is not putting in the work. If we look at Bitcoin's true inflation hedging potential, it doesn't exist. Cash outperformed Bitcoin during the period of inflation. This is the basis of the company's strategy, is to continually misinform the shareholder. And the videos I already put out were about what is really going on with the shares and the share price. It is volatility that matters for the convertible bondholders, not the direction of the price, but the volatility. The direction will be what the direction will be until it needs to go in another direction, and the shareholders are infantry, they're cannon fodder. I don't think anybody really cares if you live or die, as long as you keep throwing yourself into the battle. And how do you throw yourself into the battle? Keep telling you stuff like this, keep misinforming you, keep making you think that this is real when it's not. It's all heavily manipulated for you to act in a particular way that benefits somebody else. Later this week, I'll put a video out talking about a couple of things. Number one, we have seen crypto before, not so much crypto, but we have seen this before, this idea of different currencies. We have seen it before in history. It was called the free banking era. Railroads, mines, banks, construction companies, even individuals could issue their own currency. At one point, there were 8,000 currencies. And the whole industry was full of fraud and criminality. Sound familiar? Right? Just kind of like crypto now. I'll also talk about the strategy that MicroStrategy is following and how it is pretty much counter to the principles of Bitcoin and the principles of crypto. How the people in this industry should be dead set against what MicroStrategy is doing, but they seem to be cheering it on. And then I'm going to give you a 3-courtroom thought experiment in which we can evaluate the management. In every company you invest in, you have to think about who the managers are, because at some point you have to rely on good management. You have to use the good management backstop and say, well, what if things go wrong? Well, we rely on management. Management will be able to execute. And you want to invest in good management. We'll use a 3-courtroom thought experiment to assess management here. And that is it for the week.